All right, let's start this week's Finquinity podcast. So, let's talk about how the market basically recovered from the lows.
Yeah, the market we had all time not all time lows. We had liquid lows. We saw the lowest of lows from the start. I want to say of this chaotic period, which I want to say is like October 13th, October 10th, and we had lows basically bringing the Nasdaq down to 24,000. If I have to give a percentage, it's like roughly 4 to 5%. The market was down by. And within the last week, 2 weeks, the market has recovered to basically where we left off, or grinding towards all-time highs, despite usually the month of December, which is typically a month for a profit taking and loss booking. But despite all this, things have been good. But I think a good point to ask is: are things really good, or is it just chaos? Where like it's like a blind evaluation of to why things are good.
Yeah. So, going to back to our last recording, we talked about how there was a lot of uncertainty and how there is a problem with AI kind of having its bubble being deflated. And I think that with this rally that we're seeing, it's still what I would consider a relief rally, especially by the fact that this recovery isn't being headed by really risk-on assets like Bitcoin. So
Hmm.
when we take a look at Bitcoin, it bounced from the lows. The lows were around 78, 79,000.
Yeah.
And currently, it's having trouble pushing past 95.
Hmm.
So it's been chopping a little bit. We don't know if Bitcoin's going to go back to the lows. I don't think it will, just because the market has been doing pretty well so far in recovering from its own drawback. And what I think is happening here is the market seems to be not euphoric, but a little bit uncertain. And I think that we're starting to see buyers step in now because that sentiment is starting to recover.
Yeah.
I
Maybe
think it's going to, yeah,
maybe the right word is like cautious optimism.
that's right.
In
Yeah,
the market.
yeah.
I think like a good segue is obviously come back to Bitcoin in a bit. Is that we now next week have the rate cut decision. So if I just go ahead and look, December 10th is the rate cut decision. And in a very surprising twist of fate, we saw the rate cut chances dip to like 30, 35% or 40%. And if I go check Poly Market now, we can see the rate cut decisions have a 93% as per Poly Market. And I think overall, as per the overall market, I would say around a 90% chance of a 25 basis point cut, which I think is obviously driving the optimism back into the equity markets. But more importantly, it's about what the rate cut forecast is looking like into the next year, especially because Powell is stepping down in the middle of the year next year.
Yeah. So there's a lot to talk about, right? With that, the first thing I want to link this to is the fact that despite December's cut being priced in near certainty, when you look at TLT has not been doing super hot.
Hmm.
And I think what's happening here is while the market on the short term loves having these rate cuts being priced in, the bond market is sniffing out inflation risk with these cuts pricing in. And I think that there is fear that with the Trump administration potentially replacing Powell with someone who's more on the dovish side.
Right.
There has been rumors that the front runner candidate for chair of the Fed is going to be Kevin Hassett. So, just to give you a biography, a small biography of what Mr. Hassett is. So, Hassett was, was an economist, and he's quite experienced in what he does. He's very familiar with markets, and he's worked with previous administrations, such as the Bush administration. He was part of McCain campaigns and his team when he was running against Obama, and he was also part of Mitt Romney's campaign team as well. So he has been around the political sphere economically for a while now. So it's not like he's some guy that came up from the bushes and Trump decided to kind of, potentially appoint him. The risk is that Hassett has been basically playing as a yes man for Trump's economic policies over the last year so far. And the risk is that he is deliberately going to sandbag the numbers and advocate for cuts inappropriately.
Mm-hmm.
And I think that the markets is planning that he's going to get appointed as chair, and they're worried that he's going to be too exorbitant with cuts, and that might play a role in worsening inflation and inflation expectations.
I mean, it's all a very compound system, right? Because we have seemingly three factors at stake with this one rate cut decision. Number one is the decision itself. If it doesn't come through, that's a pain point. Number two is the official rate cut forecast, which I think is something that we will see, the dot plot on what the 2026 rate cut forecast is looking like. And number three is going to be about this potential turn in the Fed structure with the new board member, the new head of the board. So we have these like three risks, three information battles that are going on in the market. And I think definitely we can say that based on the job data we saw from the private ADP job report that, hey, unemployment rate is not great. I think also the official unemployment rate was 4.4%, if I remember correctly. I'm just looking at the data as I can. Yep, 4.4%. Just verifying. Yeah, it's 4.4% from mid-November data. But obviously, that might not be official data. And this is kind of a blind cut, right? Because we're going for a rate cut with, again, a very chaotic and messy data. So we will see what happens. Everyone's pricing it in. So it probably will take place, but it's not the most informed cut. But I want to ask you about the rate cut forecast. What do you think the forecast is looking like in 2026 if we were to ignore this third factor of, um, you know, a new Fed head?
Yeah, so that brings up a really good question because that segues to the topic of what a terminal rate is.
Mhm.
So a terminal rate is basically the expected rates that the market predicts the Fed will cut down to after the cuts are priced in. And so far, we haven't really seen the terminal rates move super low. In fact, the terminal rates has barely changed. It's just whether the cuts are either being done earlier or later. And if they're not being done today, they get pushed for tomorrow. So that's what the sentiment of the current market is. There has been a consensus now in the economics sphere from these institutions such as the OECD and the IMF that major central banks will begin to halt their easing cycle in the next 2 years or so. So there's an expectation that because of sustained inflationary fears and a lot of cuts have already been completed, the central banks around the world are going to go on a wait and see approach to see whether or not inflation will get worse and whether or not further cuts are warranted, or if worse, hikes get priced back onto the table.
I think
So, yeah.
I was going to say the hikes would be a very interesting thing because where is inflation going, and what is a good rate of inflation? Because inflation, obviously, because of the one-time activity of the tariffs, it's still around 2.8%, cooling from 3%, yes, but it's still far above what I expect the U.S. target of 2% to be, right?
Yeah, like proxies for the inflation readings, you can kind of get that on TradingView.
Mm-hmm.
So when you look at the ticker GSG, right? So that's the commodity index. We don't really talk about that, but when it comes to inflation, it's something that we should. So the GSG, this ticker has been priced back to highs, right? So what's been happening here is you have it getting tanked down, and you compare it to bond prices. When GSG goes down, the bonds tend to go up. So GSG went down, bonds went up, but now GSG gets pushed back up. The bonds have kind of been responding inversely,
Mm-hmm.
and that's gonna spill over to production, industrial production, and overall inflationary pricing, because you have commodities no longer acting as a disinflationary force on the overall uh, economic pricing power, right? So GSG seems to be running red hot, and then what you can do is you'll look at crude oil futures. So
Mm.
crude oil futures
Yeah.
has kind of rebounded from the lows on Anchor,
Yeah.
and it's no longer making new lows, not drilling anymore. It's in fact actually rebounding and entering a chopping phase. So what does that indicate? So that indicates that despite the rate hikes that the Fed has already implemented, it has not depressed demand overall. And commodity demand is chopping at best. So we're not seeing commodities going down, which if they were going down, it would help us get that inflationary target to continue moving down.
Mm-hmm.
We're not getting that anymore. So the only aspects of inflation that's left that we haven't really talked about besides commodities would be services and putting up AI.
Yeah.
So when we talk about service inflation, what does that mean? That refers to the fact that inflation isn't just based on commodities, but it's based on how much you pay someone to complete a task. So there has been this fear with labor shortages and people having more power to bargain higher wages. And unfortunately, these type of inflationary pressures tend to be very sticky. So when someone negotiates their wages to go up, that's the new market low. You're not gonna have someone negotiate those wages down unless you're in a recession, which we're clearly not. We
Mm-hmm.
might be getting there, but we're clearly not there yet. So that sticky force has been very stubborn, and we've been seeing that over the last couple of years since the rate hikes were completed. That force is still here, and it's not really trending down. And then lastly, you have the one force that's considered deflationary, and that's AI.
Yeah. Right.
And that force, I put a asterisk on it
Oh, definitely.
because when you talk about AI, in some ways it's considered deflationary, but in other ways it's not. And I can kind of discuss that. So let's talk about why it's deflationary. First of all, AI, what it does is that it makes employees more productive. But that also means that companies are more likely to reduce headcount, signifying more layoffs and changing the structure of the labor market. So the labor market gets depressed, and you're increasing productivity. So you're being more productive. So overall, being more productive actually allows you to produce more in supply, and increasing supply overall leads to lower pricing. So that can be deflationary. But AI has also been inflationary as well in the ways that really matter. We talk about those, data farms, right? That has been consuming massive amount of power and local commodities across the U.S. and has been driving up electricity prices. that definitely factors in to inflation. So you have multiple forces that have not been aiding in pushing this inflationary level back down to pre-pandemic levels. And you have the one force that's supposed to be deflationary actually providing inflationary tendencies as well. So that's why I think we're kind of stuck here. And that doesn't even get into the fact that demographics are also not on our side, because you have a lot of baby boomers also retiring from the massive labor force as well.
Mhm. Also, just to add on with the inflationary pressure of AI, I think it has to do a lot with the infrastructure spending that's currently happening into
Yeah.
AI. That's continuing to happen to create a world that is, ready for widespread AI. But I think obviously once that road network analogy, right, where like once the highways are built, once the data centers are built, once like the infrastructure exists, we would see that inflationary pressure definitely go down for a while. But for the next 2, 3, 4, 5 years, we're still going to be in the infrastructure development phase. So I think this inflationary pressure is here to stay. So AI definitely is going to have both a deflationary and inflationary impact. But the inflationary impact is definitely going to be felt in the next coming 2 to 3 years.
Yeah, I agree with that. I think a really easy way to phrase this is AI is long-term deflationary, but short-term very inflationary.
Hmm.
Um, and based on the fact that we have a lot of inflationary tendencies already happening, with a potential guy who's basically just going to be blindly cutting rates, right, to appease the Trump administration, and you also have tariffs making doing business just overall more expensive. There's just a lot of forces that are propping up inflation to the point where I'm genuinely surprised that inflation has not been moving up, and that we've just been chopping around like the sub like 3% to 2.8% level.
It's very surprising, actually. Quite surprising, but yeah.
Yeah, yeah. But that also raises another question mark, right? Is despite all these forces, why is inflation still stuck here?
I mean,
What's causing it to stay here and not move up? And I think that it opens up a conversation of, are the current economic policies creating distress in the overall economy? We talked about this in our last recording, where at least 12 states now are reporting economic contractions, and it's being buffered by other states in the South that are rapidly growing with this new AI development.
also to really talk about what's really happening with the consumer side is that we had, for example, the Black Friday and the Cyber Monday event where there were record sales on online spending. And obviously, we saw less footfall in stores, but a lot more online spending. And more importantly, so much of the spending, over $1 billion of the 14 billion total revenue, came from buy now, pay later. Uh, Obviously, this shows that the consumers are strained. We look at something like credit card debts. We look at something like um, mortgage debts. These are all things that are approaching all-time highs. They're actually kind of exponentially approaching all-time highs. And what is that what's really saying that about the consumer market? So I don't know. People seem to be not necessarily out of money, but it's not a good sign, right? It's not a good sign. It's not a good sign that consumers are taking so much debt to buy gifts and spend on Black Friday. This mentality of, hey, it's because I can buy now and pay later in installments. They just go ahead and spend.
Yeah, there has just been a lot of debt financing. You have a lot of consumers now living paycheck to paycheck, and it doesn't help with this new AI phenomenon laying off like high paying jobs, right? The tech sector is being restructured right now, so there's just a lot of vulnerabilities. But going back to debt financing, back like 10 to 15 years ago, you didn't really have people talking about getting a micro mortgage for their Subway sandwich. But now that's a genuine conversation, right? Like people pay in parcels after buying a hamburger, which sounds outrageous, but we're moving into a position where people are now struggling to afford luxuries that were easily affordable in the past. And not only are they having trouble affording it, they have to borrow money in order to consume it.
I mean, to be fair, it has felt like for a while that the kind of world at large is moving, especially America, I should say rather, is moving in that direction because just think about things that used to be bought as bulk and that are now bought in subscription type packages. Phones, hardware, OS, right? You used to buy those things as, hey, let me buy a phone. All right, I'll spend like $500, $800, $1,000, and I own the phone. But more and more, it's the case that, hey, let me just pay $20 a month for 3 years, 2 years, and this is the way I own the phone. The same way for operating systems in a certain way. We're definitely moving in that direction where it's like, oh, instead of buying the OS, instead of buying Microsoft Excel, let me pay Microsoft every year $70 so I can continue using their products. And then it just in that light, it definitely feels like the consumer market is heading more and more towards these bite-sized payments, these subscription-style payments, and really everything. And I think obviously it's not a good thing, I would imagine, because the money, you don't have the money to buy it at once. Or maybe you do, but you are, like you said, you're taking a debt. You're taking a debt to buy something now, saying, hey, the money that you're owed, I will deal with it later. It doesn't really instill too much confidence in the markets.
Yeah, it certainly it doesn't sound like it's sustainable, right? But the market doesn't really care about that.
No, they don't. The market really doesn't.
It doesn't, right? It just cares about like the growth of today and maybe, a year from now, right? Markets talk about valuations. They don't talk about sustainability. Now, when the sustainability part comes in, you'll see that being reflected in the market real fast.
Yeah, by that point, it'll be a nice check, nice reality check if it does happen.
Yeah, right.
I hope not.
Right. But... Yeah. So if there is like that, if there's a reality check, you'll know because you'll feel it when there's a drawdown. But it's not here yet, and it looks like looking at the markets, we just went through a drawdown. So it might be a while before we're gonna be bearish again. I remember seeing on FinTweet, which is hilarious, that Michael Saylor is going to prison. Like these companies are going bottoms up, and it's so over. Everyone's in shambles. And now we're talking about Meta going from 585 back to 670. Right? Can you believe that? That is a swift change in overall market sentiment, and that makes me think. And I've been talking about this to you in the past, where whatever FinTweet says, just fade it. Like these people have no idea what.
Yeah. It's just like FinTweet's very reactionary, and they react too strong. And maybe it's a good experiment to see if they react strongly, if we should do the inverse, kind of like an inverse Cramer ETF, inverse FinTweet.
That's correct. I've been noticing this pattern where it's basically another Jim Cramer indicator where you can just like fade it, and more often than not, you're actually probably on the right side of trading. Whatever you do that's opposite to the consensus at large.
I mean, it's an interesting experiment in psychology, right? When maybe it's the case that by the time it gets to FinTweet, it's that it has reached too many minds, and so it's kind of like too much saturation in the negative aspect, and so it's like things have already passed by the time FinTweet reacts to it. Maybe I'm not sure. We're looking into.
Yeah, but yeah, I think we can call it wraps on this week's episode.
Yeah, it's been unfortunately, there's not too much clarity we can look at. We look at the markets. Markets are all-time, not all-time highs, pushing towards all-time highs. Um, Look at the macros. Everything looks like we're heading back towards growth, which I think is good news, especially in the short-term sense. Obviously, we talk about what's really happening in like the underlying of the market with the potential consumer debt, all like these bigger picture issues, but I don't think it's quite there something to worry about. I think obviously keep your eyes and ears tuned to what is happening in the cut happening next week. Pay attention to any media and the press conference that happens after for the forecast.
Yeah.
And I think that will be the best clarity that we could probably offer in the short term. Other than that, things are always looking a little bit scary, but I mean, if you're always a perma bear, you're never gonna you're never gonna make any profits. So keep these big picture problems in the back of your mind, but definitely should feel free to invest in the market. Maybe now is a good time if the signs are to be believed, if the growth is coming back in terms of the macro sense. So keep your ears peeled and hope to see you guys in the next podcast. Thank you.